Struggling with the NJ bait? Well, here's an update and some guidance. This is the Issues Watch podcast. Hi, I'm Jeff Kazerman, Vice President of Government Relations at the New Jersey Society of CPAs, and welcome to episode 67. To say that the first year of the New Jersey Business Alternative Income Tax has been rocky would be quite an understatement. This important new law, which was drafted by the NJCPA and signed into law in January 2020, has been plagued by delayed availability of forms and unexpected interpretations by the New Jersey Division of Taxation. So here to provide an update on where things stand with the debate is NJCPA President Alan Sobel. It was Alan who sparked the idea that eventually became this new tax law. So there's no one more passionate about this issue or more qualified to talk with us about it. Welcome, Alan.
Good morning, Jeff. We meet again on this topic.
Yeah, it's probably the 97th time since the bill was drafted. Okay, so since things regarding the debate are subject to change, it's important to note that today's conversation is taking place on March 29th. Alan, as I mentioned, the problems with the debate have fallen into two broad categories: delays with the forms and interpretation of certain important provisions. Let's briefly touch on the forms and the changes that were made at our request that the Division of Taxation has provided for filing the forms.
Let me take it one step back. First of all, you talked about how this was an important piece of legislation. And I think we can't lose sight, our members shouldn't lose sight of how this has been widely adopted, at least preliminarily, by our members in advising their clients as well as taxpayers. Through the month of February, the Treasury has reported that they have collected $1.185 billion. That's $1.185 billion of tax revenues from the BATE program. In addition to which, we've been informed by the Division of Taxation that there have been approximately 12,300 actions on the BATE program, which meant that companies either made payments, filed elections, filed tax returns, or something of that magnitude. 12,300. So clearly, this legislation had broad appeal and was successful in its coming about than anybody could possibly imagine. So that is a framework. But unfortunately, it has had, as you said, many sort of hiccups along the way with regard to its implementation. And the first area was that there was a lot of delays in getting forms out, certainly forms that anybody could rely upon. And so it wasn't really until December of 2020 that we really got a first look at what the Division of Taxation was going to be doing with regard to how taxpayers, businesses were going to report the BATE program. And unfortunately, when they rolled it out, we found a number of issues associated with the rollout of the forms, and we immediately started communicating with the Division of Taxation to try to get these rectified. And so that created even further delays, and it really wasn't up until the week before the deadline, the March 15th deadline, that ultimately we even had some of the forms, like a revocation form, for example, or final forms that tax software companies could adopt into their tax programs. And that's notwithstanding that there still remain some problems. So again, there were a lot of delays in getting the information out, which caused a lot of frustration amongst our members and practitioners throughout the state of New Jersey, and frankly, throughout the country, that we're still trying to rectify. So Jeff, as you know, one of the problems with all these delays is it put a tremendous hardship on taxpayers and practitioners with the ability to meet the deadline of March 15th. So the NJCPA lobbied fairly hard, the Division of Taxation, to seek what they refer to as a grace period up until April 15th. Now that has subsequently been moved to May 17th, which is further a delay, a further grace period for the BATE filing. So that not only does that cover the filing of the tax return, it also includes the election to be for the BATE tax. It also includes the revocation for the BATE tax, and it also includes the payment of the BATE for the 2020 year. What it doesn't cover are estimates for 2021. Those still will be due on April 15th, the original date that those were due, pending further action on behalf of the division or the governor to extend those further. So we did work hard with the division to get some relief. I must say that in this regard, they were very helpful and worked with us to ensure that taxpayers had ample time to do this the right way. But we nonetheless had to work towards getting that extension.
Now, Alan, based on the over $1 billion that you mentioned was filed, does that give you any idea of approximately how much money those taxpayers are going to save, on a federal basis?
Well, Jeff, we really can't know 100% sure because different taxpayers fall into different tax brackets. But if we were simply to apply a 20%, which is a pretty conservative effective tax rate to be using, if we were just to apply a 20% tax rate, New Jersey business owners would save over $240 million in federal taxes. If you apply a 30% rate, you'd be at close to $360 million. And keep in mind, this was only through February. This was before the due date of the tax return, the original due date of the tax return of March 15th. And most or a lot of taxpayers would be making their payments, their final payments, if nothing else, on that March 15th deadline. And I only suspect that number is going to go up, not down.
And that fits pretty much with the projections, estimates that were made before the bill was signed or right after it was signed, that this could save business owners like $400 million. So that's good. That's good to know. It's free money, that the state doesn't have to pay for. Now let's get into the problems, rather significant ones, created by the division's interpretation of the statute, which many CPAs are very upset about. Alan, when we met with the division representatives on March 23rd, you outlined 3 significant problems. Can you provide an overview of each one and what the response was from the division staff?
Sure, Jeff. And so first of all, I'll take the easy one. The first one was delayed forms and the intense compression to be able to get the tax return completed. So the first problem was the due date itself, the March 15th due date. And we were, as I mentioned just recently, we were able to get that extended until April 15th and now subsequently to May 17th. So that was the easy issue. When I say easy, it's behind us now. That one's been taken care of. And while there may be further changes, for the most part, that one has been taken care of. The other 2 issues are a little bit more complex. So the first one deals with the basis, for which what is referred to as distributed proceeds are based upon, meaning how do you calculate the tax in the first place? The statute seems to be fairly clear to us that and the legislative intent seems to be pretty clear to us that this tax was intended to replace the gross income tax or the corporate business tax that owners of flow-through entities would pay. What that means is that it should duplicate what the New Jersey tax basis is. Instead, what the Division of Taxation has done, and we're not quite clear on how they got there, other than they say it's a strict reading of the statute. I don't read it the same way, and I know a number of our very smart members who specialize in taxation, particularly in New Jersey, as well as our lawyers, have indicated that they also don't read it the way that New Jersey is reading it, and they feel that New Jersey is a bit of a stretch. The Division of Taxation, I should say, is stretching to get to the reading that they have. The statute, in our opinion, clearly says that it should be basically the tax that you would pay under the New Jersey gross income tax, which means that you would use New Jersey's tax basis for calculating the tax. So what does that mean? Right now, the forms start and end for all intent and purposes with federal ordinary income. And what that means is it doesn't take into consider such things as the differences between New Jersey and federal on items like the bonus depreciation. So as everybody knows, New Jersey has decoupled from the feds from allowing bonus depreciation, which means that New Jersey's taxable income in the year that you purchase equipment is going to be substantially higher than what the federal income is, because the federal allows you to write that off completely. So that's one example. Another example is the deduction of meals and entertainment. Under federal law, there are limitations. Under New Jersey law, you're entitled to deduct 100% of it. Again, it is a difference. And then another example that we've noticed is the actual deductibility of the bait itself. So the whole idea here is that the bait tax becomes deductible for federal purposes. If you start with ordinary income, effectively for New Jersey, you're getting a deduction for the bait. And so you get into this circular calculation of you calculate the bait, you deduct the bait, you recalculate the bait, you deduct the new bait, you recalculate the bait. And essentially you cannot solve for the ultimate bait calculation. And so that's another problem that occurs here. So the first issue is the idea that New Jersey is using federal ordinary income for computing the bait, when we believe the statute supports and we believe the legislative intent supports that it should basically mirror what taxpayers would pay under the gross income tax or the corporate tax, as the case may be.
The division has said that they will consider making changes to this in 2021, correct?
That's right. They have indicated to us that they see the merit of our position and they will consider changes for 2021. But we are going to, and I don't want to get ahead of it here, but we are going to try to get some changes made for 2020 still, even though we know that that may be a difficult road to hoe. But we'll talk about that a little bit later. The other issue is quite a bit more complicated to explain and to get into the details, but I'm going to try. It happens to deal with tiered partnership structures. So partnerships that have partners or S corporations as members of the partnership. And we felt that the idea was that the bait credit would flow through from a lower tier partnership up to upper tier entity partners. Again, a partnership, an LLC, or a subchapter S corporation, and that those bait credits would be allowed to be used against the bait tax that those upper tier entities would have to pay. The Division of Taxation has come back and said that's not how they read the statute. They read that the statute says that it can only be applied to the gross income tax or the corporate business tax, as the case may be. And as a result, their position is that you cannot use the bait credit on an upper tier partner that's an entity against its own bait tax. Now that causes a problem in the sense that now an upper tier partnership that wants to make, or a corporation that wants to make a bait election and pay the bait tax, has to file and pay its own bait tax. And then the payment, the credit that it gets from the lower tier partnership now has to be applied for a refund in the case of a partnership, or even worse, for the case of a corporation, gets locked in the corporation according to the New Jersey's position. We don't agree with that, by the way, but according to New Jersey's Division of Taxation's position, it gets locked in the corporation and carried forward for 20 years until such time as you can use it against the surtax or the CBT tax. And as we know, based upon the law, it cannot be used against the minimum tax. So basically, it's going to get locked up in there and not utilized at all. And so that is probably the most significant problem associated with New Jersey's interpretation.
And they said that legislation would be required to fix that, fix it to the way we would like it, correct?
That is correct. They believe that it would require legislative change in order for changes to be made. Again, we don't necessarily agree with that. We believe that the commissioner, or the director of the Division of Taxation, based upon the law, has the authority to implement. how payments and credits are utilized under the statute. So we believe that he should have the ability to be able to interpret that the intent of the law was to have this credit flow down to the lowest level and ultimately be utilized. But to the extent that we cannot get them to agree to that, we are prepared to try to seek legislative change. And then as it relates to the S corporation, the lockup, we believe that the language is actually quite clear that the so-called utilization of the bait credit against the surtax and the CBT tax and not being able to reduce the minimum tax below zero does not apply to S corporations, because by definition, a corporate member does not include a pass-through entity. And a pass-through entity in and of itself, by definition, is a subchapter S corporation. So we don't believe the paragraph in the statute that provides for the so-called lockup that I'm referring to as a lockup even applies to an S corporation, even though the Division of Taxation says that they see it differently. As you know, Jeff, I was pretty involved in the writing of this legislation, along with several members, and we saw this as a problem because the idea here, just to back up for a moment, remember this is supposed to be tax neutral. And
Right.
To the extent that an S corporation has its bait tax locked up in the S corporation and cannot be used against its own bait or refunded or flowed through to its members, it ultimately results in a double taxation. The owner of the S corporation is going to pay GIT tax on its profits from the S corporation, and the S corporation paid the bait tax on its profits from its flow through entity, the lower tier flow through entity, the partnership. So it creates double taxation, which is something that we fought right from the get-go to make sure wouldn't occur. And there's actually language inserted in the statute. It's the last sentence of the definition of a corporate member that says a corporate member is not a pass-through entity. And when you go one step further and take a look at what a pass-through entity is definitionally, it includes an S corporation. So when you connect the dots, an S corporation cannot be a corporate member for purposes of this paragraph because it is an S corporation, which is a pass-through entity, and by definition, a pass-through entity is not a corporate member. I mean, that's a mouthful and it's a full circle around, but at the end of the day, we think the division has got it wrong.
Right. And what was their reasoning why they're doing what they're doing? Did they offer any reason?
The best that we could get from them was that they believe that paragraph deals with the CBT tax, and S corporations file a CBT 100, which means they are technically subject to the CBT tax. In the case of an S corporation, it's the minimum tax. That's the best they could do for us. They never gave us an explanation of why they think that our interpretation is wrong. And forget about it, it's not even an interpretation. I know that this language was inserted to exclude S corporations from having this tax locked up. I mean, I just know that at the time that we were going through all the drafting of the legislation, this was a hole that was plugged, even notwithstanding that the Division of Taxation is taking a different interpretation of it.
Well, Alan, I'm no tax expert, but what you just said, about the definitions and so on in the legislation, I do look at a lot of different legislation and definition, and clearly, I agree with you. It's quite obviously an incorrect interpretation by the division. But be that what it may, we'll just have to keep pushing for that. So,
and Jeff, before you move on, let me just point out there are things that the division. There's one thing that I think the division has a leg to stand on, and I don't mean it as in like they want this to be the outcome, but rather that their interpretation may be correct as it relates to tiered partnerships. So the legislation does specifically say that that the bait credit can only be used against the GIT or the CBT. It does specifically say that. And so I do acknowledge that short of the director of the Division of Taxation using his authority to apply the use of the credit in the way that he deems to be appropriate, in the absence of that, I do think that the legislation probably needs some reworking to ensure that that credit can be used against the bait for an upper tier partner, as well as for the CBT and the GIT for lower tier partners or individual partners. But having said that, as it relates to the subchapter S corporation, I don't think there's any ambiguity that even though it cannot be used by the BATE against the BATE tax itself, it certainly should be refundable. And I should point out that there is an inconsistency between the position of the New Jersey Division of Taxation between partnerships and S corporations. For a partnership, they're saying that you should file for a refund on your 1065. For a subchapter S corporation, they say you cannot get a refund. So they acknowledge that a refund of the BATE credit is allowable, but they're saying that it's not allowable for a corporate member. And then we get back to that whole definition of what a corporate member is that I think they're missing the legislative, not only the legislative intent, but the clear writing of the legislation and the statute itself on.
Well, obviously, this is very frustrating, and the NJCPA is continuing to take action. Alan, you're involved in this. We reach out to the sponsor of the bill and the governor's office to urge them to reverse these interpretations. So we'll have to see what happens there. Now, in the meantime, Alan, what would you recommend to NJCPA members who have clients that are adversely affected by these issues?
So Jeff, first of all, I do think that the vast majority of taxpayers are probably not going to be adversely impacted in any material way by either of these issues. In the case of, let's just take the first instance, the tax basis that's being used. For the most part, clients of ours and taxpayers probably don't have huge differences between New Jersey and federal taxation. And so, you may find yourself just filing the tax return on the basis that the New Jersey Division of Taxation has, at least at this particular point, in giving guidance on. With regard to those that do have big differences, my advice is sort of twofold. On the first instance, you might want to just sit back and wait, file an extension come May 17th, file an extension and see whether we as a society and other lobbyists can find a way to work the legislators and or the Division of Taxation to see the errors of their ways and get them to change the BATE calculation for 2020. And then if in the absence of not doing that, then like any piece of legislation where, whether it's the IRS or the Division of Taxation, the taxpayer along with his advisors are going to have to make a decision about whether they agree with the interpretation of New Jersey on this in the first place, or whether they believe that the statute itself carries more weight in the sense that it speaks something differently to the way the tax should be done. So for example, let's just say you have a client who has $1 million in federal taxable income after writing off $500,000 of bonus depreciation. So that for simple purposes, let's assume that it's New Jersey's income would be $1.4 million. You might want to make the decision after, again, carefully looking at the law yourself and drawing your own conclusions. Don't rely on me on this, but draw your own conclusions to whether the statute says that you should be using New Jersey taxable income for computing the BATE tax, notwithstanding the division's position. If this were to be audited, number one, the burden of proof would be on you as the taxpayer or the advisor to demonstrate why the law is written in the way that you're interpreting it. And again, that's the burden of proof that you have to overcome. So it is a higher level than just taking a position. But again, I think the law does provide for New Jersey tax basis. Having said that, you have to make the decision of whether it's worthwhile to do that. So again, wait to see what happens by filing an extension. In the absence of that, you're going to have to make a decision like we have to do on a whole host of tax issues throughout our careers as to what position we're ultimately going to take on this. There's probably not a whole lot of damage in taking that position on the tax basis because, again, the net effect is zero when all is said and done. But to the extent that it results in a lower BATE credit and a higher New Jersey tax net, gross income tax net of the credit, it could result in penalties and interest. The total tax won't change, but the exposure to interest and penalties may be there, and that's something that practitioners have to weigh when advising their clients as such. Let me get into
Well,
the subchapter S issue though, because that one is a little bit more problematic. As I said, as it relates to the tax basis, it's a net zero effect, except for the interest and penalties. As it relates to this tiered structure with an S corporation, it's a little bit more complicated, because if New Jersey does prevail with its position that the BAIT credit gets locked up in the S corporation, as an advisor to our clients and as a client, you may wind up losing the benefit of that credit, which could result in double taxation, and that number could be substantial. And so that is an issue that we as practitioners are going to have to look at very carefully. And come May 17th, you may have to make the choice to revoke the BAIT election for the lower tier partnership in order to ensure that you do not get hit with double taxation. Now, unfortunately, that may hurt some individual taxpayers that are part of the lower tier partnership. It may hurt them by not being able to avail themselves of the BAIT. But if the BAIT lockup on the S corporation is significant enough, it may not be worth making the election. And that's something that you're going to have to weigh, because the revocation period is currently May 17th. So that's the other thing practitioners need to do right now, is evaluate how much that is going to hurt their client and whether they are going to revoke that. But we do still have some time. It's only the end of March. We have until May 17th, and maybe we'll have further guidance that will help everybody determine whether that revocation should be made prior to May 17th or not.
okay, Alan, want to thank you for coming on this episode. And to our viewers, I wish we had better news to share, but hopefully we will soon. So thanks, Alan, again. Thanks for joining us today and sharing this critically important information.
Thank you, Jeff. It's good to be here. Thank you.
One other thing, we have additional information and updates about the BAIT, which are available at njcpa.org/BAIT.